Welcome to Innovative Strategies with Bill Hasse. Innovative Strategy is a show designed to help people with their business and personal financial literacy, but not in the way that you have known. This is not your grandpa's financial literacy, as Bill uses his 30 plus years in the financial industry to stretch your financial box from, let's say about a 30,000-foot view of things. Bill and his guests have helped hundreds of clients achieve and surpass their financial goals. If you have any questions, please email Bill at bill@billhasse. That's bill@billhasse.com. Reach out to him right here at 216thenet@gmail.com. Today, of course, are you a credit genius?
Genius.
Genie. Bill, how are you?
Good, Ken. How you doing? It's good to be back in the studio.
Good to have you back in studio. Been a while.
Yeah, it's been a little while. You know, a lot of wild things going on, but it's good to be back.
It is.
Today we got a really interesting show going on here. I think this is a super important subject. It's something I'm going to add into my curriculum for the new business.
Love it.
And I'm going to work with our guest in order to do that properly, because today I have John Mackey here. John's just outside of Minneapolis, St. Paul, and he's one of the foremost authorities on credit, FICO scoring, and debt collection defense.
Nice.
So again, the credit. So people don't really understand the full impact of credit on their lives and then on their financial lives, which then into their personal and business lives and whatnot. But welcome, John. Thanks for coming on and joining us.
Hey guys, thanks. I appreciate it.
Here, I got a question for you, and this one's real simple, right? Just how important is the credit? And when you talk about credit, we're talking about your FICO score, which people know about, and they think, oh, okay, I need that when I buy a house, or I need that when I buy a car. But otherwise, how important is a FICO score?
Well, it is very important, and it's become even more important in our lives, especially since they started using it. And in order to understand the system, and nobody does, and that's one of my biggest issues. And that's why I created this educational platform to talk about credit education, because it does affect our everyday lives. You may have a 740 score, for example, and think you're getting the best rate, when in fact, if you had a 760, you might get an eighth of a point off your interest rate. It's factors like that. Can anybody buy a car even with bad credit? Yeah, probably. Yeah. But as we discussed prior to the show, and everybody gets new cars, new to them, and you could have interest rates as high as 30% if you don't know what you're doing. And therein lies part of the problem.
I mean, yeah, but it doesn't just affect even that. It affects things like your insurance.
Well, right? And that was the next thing I was going to talk about, because a lot of people react by saying, okay, fine, I won't have any credit at all. Now your insurance rates go up. Homeowners, renters insurance, car insurance, they all go up. Some states, believe it or not, and I've read some reports, how true they were, I don't know, but it was 5 times higher. State of Minnesota here, I think it's 175% or 1.75% higher, or not percent, but times. And so, yes, no matter what you do, if you have no score, if you have a bad score, your insurance rates are going up.
Well, it's funny because there's a commercial, and you and I talked about this. There's a commercial out there saying that there's, in the U.S., there's 100 million people with either low FICO score or no FICO score. Right. And I laughed at that because we talked about marketing and how that affects our spending and whatnot. Because I looked it up. 73 million Americans are under the age of 18. Well, did you know that you can't start getting a credit score until you turn 18?
Correct.
So when you get a commercial saying, "Oh, 100 million people either have a low credit or no credit score," it's like, okay, and this is the problem. This is part of the problem, not part of the solution, right? With all the
Right.
marketing that goes on to get us to spend money. But I'm going to circle back real quick. You said that, if you've got a higher score, you make it an eighth off on a loan.
Yes.
Okay.
Let's say over 760.
Yeah. Okay. So I get an eighth off. Whoopie doo. Some people are going to say, "Oh, really? An eighth? That's not such a big deal." But
Well, if it's not a big deal, I'll send you my address and you can send me the difference.
yeah,
Not
right.
that I can live on it, but if I get enough people, I
You
can make a
might
good
be able
living.
to, because I take a $300,000 loan over 30 years.
Right.
The amortization of that 1/8 of a point adds up.
Well, and that brings up a study that I don't want to say I did, I participated in, but what we did is we took two people with the same credit, meaning the same items that they were receiving. In other words, they went to school, they got a student loan, a private student loan, they bought their first house, their second house, a HELOC, maybe a couple of car loans in there. And we took a look at the difference between a 620 score and a 720 score going through life. Now, what kind of a difference is there between those two? Roughly, it's $350 per month. Now, you take that, run it out 40 years, and how much are you losing? You're losing $201,000. Now, if you were to have taken that money every month, like we're supposed to do in savings, and invested it, let's say the stock market, where the average rate of return is about somewhere between 9 and 10% for the past 40 or 50 years. I'm not an expert.
It's really 5.25, but you're very kind.
Oh, I had read differently.
Yeah.
Nonetheless, the amount of money you would have saved based on my 9.5% was $5.1 million. And
it adds up.
That's the key. And if you could take that money, especially somebody of a lower income bracket, that means a lot. It means a lot. And even my contention is that people don't know what they're being judged on. And so when you go to a credit bureau and you want to pull up a credit monitoring and you see your score and it says whatever it says, that's a FICO 8 credit score, which is the one that they use for credit monitoring.
Okay.
For a mortgage, what do they
there's
use?
Different levels, but folks got to understand there's the F2, F3, F4, F5.
Well, they started out with a FICO 95. And it started out with the conventional financing back a ways. And I believe it was the 94, 95 era. And then they changed that to rename it FICO 2. And then they've changed it ever since to fix certain items within the FICO scoring system. So it went from FICO 2 to FICO 4 to FICO 5, to FICO 6, 7, 8. Then they went to 9 and said they were going to eliminate all medical debt or lessen the effect of medical debt on your credit score. And then they went to now they're going to a FICO 10 and a FICO 10T. Credit monitoring uses a FICO 8. But when you go for a mortgage, what credit scores do they use?
They go back to the lower ones.
Pardon me?
They go back down to the lower ones, don't they? The original ones, right?
They go back to FICO 2, 4, and 5. So you're not being judged on the most recent credit monitoring system.
Or the most efficient system.
Right.
You're going
and if you wanted to,
I wanted to point out, this is important, right? To understand this system but really, we want to stick more along the lines of the effects.
Well, let's if we take a look at this, John, right? The FICO score isn't even 40 years old, maybe 30. Started in about 1989, if I remember correctly.
For conventional financing,
Yeah, yeah,
that's possible. What I was actually the FICO scoring system or credit scoring was designed many years ago. In fact, it started back in 1959 historically, but they didn't use it for mortgages
right,
until about that time, and that was conventional financing.
right.
And then in '95, they went FHA authorized it and mandated its use. Prior to that, in FHA, you had to have uh, good, clean credit for 2 years after the last bad debt. In other words, the last 30-day or 30-day late. You could have had a 30-day late, um, and that would be excusable, but you'd have to have a reason why. You
Yeah,
talk to your banker and you explain it to the underwriter. Now it's just points. It's just saying if you've got a 640 for FHA financing, depends upon the bank. You could actually go down to 580, but it depends upon who you're selling that to. Are you carrying that yourself? Now, I used to do mortgages, and it was a long time ago. I did mortgages from 1998 until 2007. But I was doing mostly non-conforming loans and FHA. I didn't do conventional. Um, and so things go crazy with the credit scoring because you never know how they're judging.
Yeah.
And if you take a look at, forgive me here because my mind goes a mile a minute and my mouth can't keep up. But you've got these various other products that come into the marketplace, i.e. credit, we'll name it Credit Pharma, okay? And Credit Pharma will come out and say, what is your credit score? And that used to bug the heck out of me because you don't have a credit score. You've got multiple. And then when they, as a teaser, pulls you in for that credit score that you're going to get, now what's their purpose? When you get something for free on the internet, you are the product.
Right.
And so they pull you in, and now what's their goal? It's to sell you credit cards.
Yep.
Yeah.
That's their total goal.
Or no personal loans.
Yeah.
Because I think the average person carries about a number I recall from a few years ago was like 17 credit cards, and that includes your gas cards, your Kohl's clothing store cards, Walmart, your Visas and American Express, all that stuff. They add up, and because the simple difference is between a debit and a credit card is a debit card you're using your own money, a credit card you're using somebody else's, and they're charging you a fee to do that.
Well, yes. And a debit card doesn't report to the credit bureau. Now, you can set up self-funded credit cards. So if you've got bad credit, marginal credit, or no credit, you can fund yourself, and it becomes credit. Now, through that book I wrote, we talk about that. We talk about installment debt and the benefit of installment debt, the benefit of revolving debt. Mm-hmm. But you can self-fund revolving debt, and that goes on a credit report. But so you're giving them money, allowing them to charge interest on the money that you supply them. So it's the cost an individual pays for bad credit or no credit.
But that could be minimal, right? I mean, it's a viable solution.
Yes.
To building credit.
Yes, and that's my point.
Because you're not talking about, you got to give them $10,000. You can do this because I've read your book, and I saw you the example you're using is $300.
Right.
Right.
You could
And the-
fund it with as much as $300. That's
Yeah,
correct.
and the interest they were charging was what, $5 a month or something? $5.39, I think it was.
Right.
So that's minimal to have a good way to get yourself back into a better credit FICO score. And when we talk about that, we're talking about the three bureaus, right?
Right.
And Kent's in the mortgage business. He understands the underwriting. I've done underwriting and processing loans as you have, and we talked about this. And we typically get one score from each of the three bureaus
Right.
when we're underwriting a loan, and we take the middle one.
Correct.
And it's kind of like you don't know how real or close that is to reality. It's kind of like saying, what's your home worth? Well, I think it's worth 600,000. Well, the market says it's worth 400,000, but then there's a person willing to pay 500,000. It could be, it's inefficient, I guess, is the word I'm looking for.
Yeah, I think it is too. And, if you take a look at the different scoring systems, and sometimes people say, well, really, what is the effect between a FICO 2 and a FICO 10, or a FICO 2 and a FICO 8, which is what they're currently using? And we took a look at some of the MyFICO scores. MyFICO is a website you can go to participate in for X amount of dollars per month, and you can run different scenarios. And we did that for an individual, and she had a FICO 8 of 683. When we ran a FICO 2, because some credit cards will use a FICO 2, a bank card, let's say, and her score was a 623. So there can be a big difference between all of these scores. And when numbers matter, 640, you can get your FHA loan, 639, you can't. Or you've got to go for special underwriting or manual underwriting instead of desktop. Or
Well,
you've got to get waivers.
Debt to income ratio thing as well, right?
Right. And that's what DU will take a look at. We won't get into that because that's not my expertise.
Yeah, that's fine.
It sounds to me that the system is rigged, and since there's not one model that it works, it's rigged against the consumer, so that the banks can make a lot of money. Is what it sounds like to me.
Well, and I wouldn't disagree with you. There's a lot of misinformation out there. And again, that's why I do what I do, because credit reports aren't infallible. There are a lot of mistakes that are created on those. They are huge organizations. Credit reporting agencies make in the billions of dollars every year. People don't realize also, now I'm going off maybe on a conspiracy tangent, although I'm not a conspiracy theorist, but people don't realize that there's not just 3 credit reporting bureaus. There are 40 others as defined by the CFPB. So who's looking at all this stuff? Medical records, yes. Your pharmacy records, yes. And there are a variety of others that should.
Medical records, I thought, get kind of thrown out. When I was an underwriter, we didn't take that into consideration.
No, absolutely you don't.
But it was on the report. It is on the report, which can have an effect, because you're right. An underwriter might say, hey, I need you to write an explanation of why this is here, or why you have this issue. But let me ask you something. Why is there such a big difference between the 3 main bureaus that everybody looks at when they're looking for a score?
Different things are scored differently, and balanced differently. First of all, sometimes creditors do not have to report to all 3 bureaus. A debt collector, for example, and I've got a great example with that one, where they had this individual had in the high 700s based on Credit Karma. And he thought he was ready to go. He was clean as a whistle. Then we went for a mortgage, or he went for a mortgage, and found out that on Experian, he had 11 medical debts that he was unaware of. And he said, my family hasn't been to the doctor in years. How did these happen? Come to find out, they were hiding on Experian. They didn't notify him. And when we challenged him, the credit bureaus validated the information, coming back with information that stated that the individual that they were reporting on was a 22-year-old individual, and this was a 45-year-old man.
Uh-huh.
So now we've got multiple problems here. Number one, they divulged a third party to me, in which they shouldn't have done. They had wrong information on my client, on his report, that negated him from getting a home loan, which in turn, during the time between the time we could get it removed after we found out, which was about a month and a half, interest rates had gone up a point to point and a half.
Yeah.
So now how does he recoup that?
Yeah, exactly. So there are errors, mistakes. They can be corrected,
Yes.
but you don't, and like you said, but they didn't report to this gentleman that this was reported to the bureau,
Right.
and therefore put on his file with that bureau, and the bureau did not go out to the person and say, hey, by the way,
Right.
you've got some bad stuff that just hit. And, because you can say, why didn't you check? Why didn't you go to the person whose score is affected and say, here's a new warning. Here's a new hit to your credit. And I think, hey, aren't there places where you can sign up that will do that? That will, like, monthly tell you if there's
credit monitoring, you can do that. The problem is with credit monitoring is that you don't get all of the information. You get what you don't get, for example, might be the date of last activity. And why is that important? It's important in debt collections when a negative item has to come off a credit report. So we don't know about that. There is one source, actually two sources, that have complete information. The first is a mortgage loan application. It has to have true and correct and complete information. The other one is annualcreditreport.com. Now, annualcreditreport.com was mandated by the CFPB back quite a few years ago now, in which they mandated that the bureaus had to give the individuals a free credit report once per year. I still had a problem with that because things change certainly more often.
Mm-hmm.
Now, because of COVID, they extended that to say you can get a free credit report from each bureau once a week. So you can go on to annualcreditreport.com, pull your credit report. The interesting thing here is that it is not against the law to have wrong information on a credit report. It's up to you as an individual to make sure that the information on your report is correct.
So, real quick.
Yep.
And I don't know if you know the answer to this. I think I do.
Mm-hmm.
How many people actually go and check their credit report, even once a year, but much less once a week or once a month?
I've had many people that say that they've never checked their credit score. They had no idea what was on there.
I don't know anybody. But it's not like we talk about it. Hey, did you check your credit score this month?
Right.
But so it's not part of the conversation. But I still got to believe that it's not many people. It's a small percentage.
Absolutely it is. Now, because I'm in the business, I check mine every week. I want to see how things are being reported. Not that I really need to, but I want to see if anything's sliding on there.
Yeah, well,
Hypothetically, what about children? And I'm bringing up something. Could a child have a credit report? Yes, they could. If somebody has hijacked the information,
yeah.
your child's information, because everybody born now, and for probably many years, I'm so old I can't remember, but you've got social security numbers that are being issued at birth.
Yeah.
So someone could hijack that information, apply for credit in that individual's name.
Well, you need those social security numbers because we have child labor, right? You got to go to work when you're 10 years old and start earning some money, and you got to pay taxes on that.
Yeah.
Yeah, we want to bring up.
Yeah, so just real quick, folks, this is Innovative Strategies with Bill Haase here on 21.6 Net. We've got John Mackey with us, and for more information about what John does, visit his website at www.creditgenie, that's creditgeni.us, or Genius. I love how he did that there.
Yeah.
And my understanding is if you go, and I'm showing the website up there right now, if you go there and you click the email and put in the subject line, what do you need them to put in there, John?
Depends upon what they want. What I'm offering as listeners is that if you want me as a FICO person, FICO meaning the scoring system, to review your credit report, I will do that free of charge.
There we go.
I want to do it securely. I just don't want you to send it to me.
Right.
But I want to do it securely.
So put review in the subject line.
Put credit report.
Credit review.
If you want my book on how to establish or reestablish credit by yourself, there's no charge for this book. It's about 40 pages. It's got lots of good pictures.
That's awesome.
John, I've read it. You sent it to me and I read it, and it is a quick read. If you seriously have concerns, you have poor credit or something, and you're struggling to find a way to get that back in alignment, and you should be, because it'll make a huge difference, as John pointed out earlier in the show, of hundreds of thousands to millions of dollars. This is a quick, simple read. And it's,
and that's the only way I can write, is very simply.
Very simply. Of course, it's Credit Genius, Financial Reinvention, the DIY guide. If I could read, maybe I just need to call you, John. How to start or restart your financial life. Very, very important. Great read. It's 40 pages roughly. It's you're not going to fall asleep doing this, but because
you can read this in 10 minutes.
Because the world runs on your credit score, everything down to, like you said, Bill, your insurance quotes and things of that nature. The more you know, the better off.
Yeah, I bet you many of you folks out there listening in have been getting little notifications in the mail about how your credit card's being adjusted. Your interest rate that you're paying is being adjusted. I've seen them. It's everywhere to everybody. But John, I got a really important question here too, because we talked about this as well. How far back are they supposed to be going, and how far back do they actually go? With putting your score together.
Derogatory items are supposed to come off 7 years from the date of last derogatory activity.
7 years. Okay. And
that's on the report.
Right. But
there is no time frame on a positive debt staying on there. So if you've got a long history, let's say 30 years on a credit card, they can probably report all that time. Now, what's going to show on a credit report is different.
Well, but technically, that's still active.
Well, and what John said, literally said from the last active, right? So if I've got a collection on there that's been sitting there for 6 years, and I call and wake that up, like, oh crap, let's go ahead and show that there's movement on this or whatever. That kind of restarts the clock, right?
No. No, it doesn't. Depending upon the state, Minnesota, for example, it does not reactivate. No phone call is ever going to reactivate.
Okay.
The reason why the date of last activity is important for two reasons. Number one, it determines when it comes off the credit report. Number two, it can determine how long a debt collector can come after you. So if, for example, state of Minnesota is 6 years, and if the date of last activity is 6 years and 2 months ago, and they start up a lawsuit, it's an absolute defense saying it's beyond the statute of limitations. There are statute of limitations on debt, and it was modeled after the criminal system. Now, every state is different.
Yeah.
Some states, believe it or not, are 3 years. Some are 6. I've seen one as high as 15 years. Now,
Yeah, that's Illinois. Illinois, I think, said they're like 50 years, but yeah, that's valuable information there as well when you're doing a review. And folks, I don't recommend you try to review your own credit report, because if that's not what you do, it's a challenge. It's a challenge to understand. There's a lot of numbers, there's a lot of letters, there's a lot of information on there that we as underwriters learned to read, but it's hieroglyphics to somebody who doesn't know how to read this stuff. The types of information that's there, and age and things of that. But so the thing, a lot of folks run into, okay, I've got an issue on my credit report. I'm behind. I didn't pay a credit card, and say it's 2 years, and the credit card company comes and says, okay, instead of the $2,600, you pay us $1,300, and
Right.
we're good. So you say, fine, done. You pay the $1,300. Now we understand that gets reported differently than if you'd paid it in full. But then the credit card company doesn't report it to the bureaus.
yeah. First of all, you've got to get everything in writing. One of my fortes with credit education is also debt collection defense, and I get involved in this for a variety of reasons. Number one, it was because of the abuse that a lot of my customers were receiving. Number two, there's an old adage in the legal field, and I'm not a lawyer, but it states, he who represents himself as a fool for a client. And that is so true, because you get so emotionally involved. You may say something, you may agree to something, and just remember that they're recording every phone call. So they know what they're doing. They're good at their job. And they're good at deception.
People that well, but they're good at
They're good at their job, and they may tell you, as they've told me, that once you pay off this bad debt, that your credit score is going to go up. Matter of fact, it doesn't. It goes down. So paying off a bad debt is something I say never do until you verify and validate that debt. Because if you pay off, and I've had clients do this, pay off a debt in which they didn't owe it. So number one, how do you get your money back? You don't. And then number two, you're still liable for the debt that you didn't pay. So I've got a process, and I negotiate debt on behalf of clients for debt collectors. And we go through this process, and we make sure that it's verified and validated. There are two different ways of doing it. As I stated, verified and validated. Verify means you just contact them and you say, is this your debt? Yes, okay. Send me a letter saying it's yours. Now they've got to send back documentation that says you've got it right. It's called a done letter. And that's been modified in the new Regulation F. And I know I'm throwing stuff out here that that may be going over people's heads, and I understand that. But
That's what you're here for.
but Regulation F states that they must, as they did before, but it's a new format, that you've got to disclose who you're collecting on behalf of, that you've got a right to challenge it. That's where the validation comes in. I want documentation that you own that debt as a debt collector. And debt collectors are fined all the time for violating clients' rights. Now, do I believe that someone that owes a debt shouldn't pay the debt? No, I'm not. I'm not saying that at all.
Yeah, we're
What
not.
I am saying,
That's
Go.
don't go there.
There you go.
I'm saying validate the debt. Get it verified and validated that in fact you owe it and you owe it to them.
Right.
Okay. Number two, you've got a right for the documentation. I want to know how you bought it, where you bought it, because most people don't understand that debt is bought off of an Excel spreadsheet without the documentation coming in. I want that information.
Yeah. Well, okay. So let me ask you this. In my example I used where you owed $2,600, you haven't paid it a couple of years.
Yeah.
They offer you to pay it off at $1,300. What effect does that have? On your
Number
FICO
one is going to go on the credit report as paid in.
debt? You said my score is going to go down.
It is. But then, do you want to wait for the lawsuit to come? Because if a lawsuit comes, now most people bury their head in the sand again. Sometimes that's even when they find out that they've got this debt. Now, that's not to say that people don't bury their head.
Right.
I know they do. Okay,
Right.
but let's start standing up,
So,
because the sooner people take control over their financial situation, the better off they're going to be and feel. And the quicker you can get rid of this disease.
and-
Working on that.
And John, if you can go over kind of how your credit is measured, the weighting of it, because you're right. I had a mortgage for 18 years. We sold it, right? So we sold our house last December. And when that loan was paid off, that we had open for 18 years and was good on it, our scores dropped about 100 points. It was a lot. I don't know if it's
Whoa.
100, but at least 7. It
That's-
dropped a
yeah.
ton. Because
And it could have been in a combination. That's
Yep.
true, it will, because you're eliminating a trade line for
Yeah.
review.
Yeah.
But it could also have been when you did it, because the biggest score drops happen. Number one, if you're late on a payment, and I'm not saying you were,
Right.
that'll, if you've got a great score, it could drop you 125 points just by missing one payment for 30 days. Or your credit ratio, which is something I wanted to get in
Yeah.
before we go any further. Credit ratios have to do with your revolving debt. And the critical part here, and let me just give you an example. We've got, I worked with a lot of people in the construction trades, and they would buy up all their product that they were going to use, let's say Menards, it's not a plug. And so they've got a $20,000, $30,000 line of credit there through a Bank of America card or credit card or something, American Express. And then at the end of the month, they get their bill and they pay it off. What is going to show on their credit report? It's going to be what the bill was.
Oh, okay. Okay. Yep. Okay. See, I
Okay.
would say 0 because you paid it off.
Correct. You feel like you've done the good thing, but what's going to continually be reported to the credit bureaus is a maxed out credit card. So 5 days before the bureaus are reported to by the creditor, you need to pay that bill off at that point.
So
follow?
yeah, I think it was in your book. You were talking about the 21 to 25 days.
Yeah.
Correct.
So so an example, if your bill is due on the 1st you want to pay between the 21st and 25th of the month, that will have the greatest effect.
Yes.
Okay.
Yes, that's exactly right.
That's why you want to ask him to get this book. You want to go on his website. You want to click on an email and say, send me that book, please. Because again, it's 42 pages, but it's filled with this great little information, tidbits of information that you should know about. John, you're right. We need to develop financial literacy in this country, in this world. And I know some people are working very hard on that to try and bring that to the table. Because I guarantee you, I don't know anybody out there who would have thought that when they paid off a debt that their credit score would actually go down.
I know.
And hard.
So, and again, if you go out to, Bill, you're going to share it right there. If you go out to creditgenie.us, so Credit Genius, but put a dot between the I and the U, and you click on email, connect, and then just put free book in the subject line, right, John?
Yes.
You'll get them that free book.
Yeah, he'll send it right back to you.
If you want to work with John on your own credit, in the subject line, there, just go ahead and put free report.
Right.
Yep.
Or if you want me to evaluate your credit report, no charge.
There you go.
We've got to start standing up. We've got to start understanding how we are being judged.
Yeah.
And unfortunately, although they say they don't judge us, you take a look at how we're being marketed to. And it's not even part of what I can share with you today. But they've got 3 pages of terms that they use, that they put us into groups of people. And it has to do with income. It has to do with a lot of different factors. But they group you into groups of people. And this is how you're being marketed to.
Yeah, right. Yeah, it's in the financial world, nothing is simple. Nothing is easy. It's on purpose designed to be confusing. Even the little things. I guarantee you, folks, go look at your most recent IRA statement or your 401k statement, and I ask you to tell me what fees you're paying. I bet you don't know.
No.
I bet you don't even know where to find it.
Well, and here's our literacy on what John does.
Yeah.
Borrow money, make your payments on time, good credit. That's what we're taught.
Right.
That's exactly what we're taught.
But it's not true.
Right? Because there's weighting in there, right? So you were talking about some ratios and how things were weighted as you look at the FICO score, John.
But it's when you pay that debt.
Is it?
Also, yes, that's critical, especially in the long-term debt, meaning your credit card debt.
Okay.
That's a critical factor. That's 30% of your score. Paying payments on time is 35%. Credit cards are 30%.
Wow.
Well, here's an example. So the majority of people wait until the day the bill is due to pay it.
Right.
And right, it doesn't matter. Gas bill, electric bill, car loan, mortgage, anything, right? If it's due on the 30th, we pay it on the 30th.
Yes.
Or we go in and we log in and we say, okay, on the 30th, make this payment out of my account.
Yes.
But what I'm hearing is that's not the most effective way to handle your finances.
No, it's really not.
Between that 21st and 25th day, not wait till the 30th day.
Correct.
Okay. I just want to emphasize that for folks because it's a different mindset. Yeah. Because we are preset to make those payments because we want to hold on to our money as long as possible, right?
Yeah.
So we hold on to the very last second to make those payments.
Yep.
And therein lies another problem, right? Because system's down. Can't make the payment. Can't take the payment. So now it's a day late. Boom. Problems.
Or you don't hit, especially with credit cards, right, John? You don't get it in by 6 p.m. or whatever the case may be. You might be you might be at work and still you're due on let's just say today, the
Yeah.
16th, and then you
Right.
go, you paid
Oopsie.
after 6, and they're like, "Oh, sorry, we're closed," so because we're on the East Coast, whatever.
Well, there's things like that. There's also, you got to be careful of a couple of things I want to talk about, John. But one thing, an issue that my wife and I ran into is we went to a particular store to buy an appliance.
Right.
And because if we bought the appliance using their credit, we would get points towards our next purchase. And we were going to look to purchase more appliances. We were building. But the problem was we had to put X amount of cash down because they said, okay, we'll only give you this much credit because we'll only give you this many points. So we said, okay, fine, we'll do that. And then I think the credit line was $1,500. But for some reason, when they opened up the line of credit, they charged $1,600. So immediately we get hit on our FICO score because we exceeded, the full amount of what we could use. So that's a big whammy, number one. And number two, now you're carrying, 100% debt on that line of credit.
Yeah.
And that
And
goes
let me-
against you, carrying, on a credit card, if you have $10,000 that your credit card's good for 10 grand. John, where does it start becoming painful on your credit report? We're at 5 grand that you've got on there, or 4 grand?
No, it really doesn't have anything to do with dollars. It has to do with percentages. And I always like to tell my people to stay below 15%. Now, you're going to hit critical mass at about 85 to 90%. Where it really gets beyond critical, catastrophic, is when you go over your limit. And you're going to see some huge point drops. So let's say you're maxed out on your credit card, but now you've got interest that you didn't pay. So now you're over. That is verboten. Don't do that.
Yeah.
Beyond anything, don't do that. Their credit cards are the bane. They can be wonderful things to have, but you've got to know how to use them. And before I forget, we're coming up against the holiday season, the Christmas season. Shopping is going to start here in a couple of months. And if all these department stores offer you free credit or offer you 10%, 15, 20% off your purchase if you apply for their credit card. Caveat here, don't do it.
Don't do it.
Let me tell you why. Because I've had people lose 70 points just by applying for credit cards over the Christmas holidays.
This is an issue because people do not understand. If you have a credit card that has, let's say, $10,000 available to you, and then let's say you have 10 of those, so now you can actually go out and charge up to $100,000, right? $10,000 on each card, and then you go to buy a house and get a loan. You're buying a $200,000 home, and they're like, "Well, wait a minute, you're carrying $100,000 line of credit,
right?"
And they're going to count that against you.
And that's why HELOCs can be so difficult.
Yeah. HELOC being a home equity line of credit.
Right.
Absolutely. Let's bring this up too.
Yeah, and let me make a change here. It was a typo. Actually, it's not a typo at all. The brain chasm in that I wrote down Tuesday, and it's not Tuesday. Today is Tuesday. I think. No, today is Wednesday.
You're getting there.
Wednesday the 6th.
I'll get there.
Are you paying bills on time?
No. November 17th, which is tomorrow, Thursday, at 11 a.m. Central Time. I'm going to do a presentation on FICO scores. And I'd like you to attend. Anybody that's listening that wants to, you get to really get a close-up look at me. I will speak in dulcet tones, and we'll go over the credit scoring system. And I think, in my opinion, it's vital.
Yeah.
Credit education is vital. Knowing about your credit is vital. Why do you think
100% with you.
bureaus don't want you to challenge? Because they say they've got everything right.
They don't want you to know.
They
don't
don't
want
want you to know because
don't
they
want you
make more money
in their world.
or
Get you-
ignorance.
People are going to demand changes if they finally figure out what's really going on.
Well, I want to make this clear too. This is a free live webinar that you're doing tomorrow at 11 Central, and you can sign up at Credit Genius, so creditgenie.us. So it's creditgeni.us/credit education. Now, let me help you as well. Being a person who's been part of banks and in the banking financial industry for 20 plus years, I'm going to say it's well over 50% of your bankers have no idea how this works as well. So you can go sit with your personal banker,
Yeah,
and they'll be
right.
like, well, it just says this is good. This is what we would call a paper. So
Don't worry about it. You're
you
720.
need to make some more on-time payments. I mean, so trust me, I've managed those people. I know those people. Probably even as high as 75% of the people who work in banks have no idea what John is talking about here and how it affects you.
Or your financial advisor.
Yeah.
I've learned so much since I've met John and had these conversations, and the purpose of him being here is because of the value and the importance of this. But John, we're up against a tough crowd because for some reason people just don't like to take the time to understand and educate themselves on financial scenarios, right? Financial literacy. We aren't taught it. You've heard me say on the show before, Kent, there are two things, most spouses don't talk about. Finance is one of them. And then you don't talk to your kids about it. Yeah. So it perpetuates and rolls over. And we go through life, as you said, John, we stick our head in the sand sometimes and we hope things bypass, and it doesn't. It can snowball.
So much of life is all about pain and pleasure. And we will avoid the pain as much as we can to get to the pleasure. Sometimes we've got to forego the pleasure so that we can have more pleasure at the end.
Yeah. I forget who the author was, but he said it's a sales deal, and it says, he goes, a person will buy something for only two reasons. Number one, because it brings them pleasure. Or number two, it's to avoid pain.
Yes.
Those are the two reasons why anybody buys anything.
TV shopping networks.
although you get a pretty good gut check in the first time you buy a home, and you put yourself in that huge amount of debt, and you're just like, oh.
So let me ask you two a different question. The prime rate has been climbing through the roof, which is affecting the variable rate credit cards that people have. Now, many people have well over $10,000 in credit card debt. And now we're seeing all those those payments are some of it double for people.
Let me add to that.
Yeah.
What people aren't seeing, they're seeing all these numbers that are coming out that says everything's hunky-dory and we're not in a recession. We're in a transitionary position, which you never put those two words together. But the reality is one thing they're not showing is how fast credit card debt is going up.
You're right. You're absolutely right. I just read a report on
a credit card and not cash because they don't have it anymore.
30, 60, 90-day lates on vehicles are skyrocketing right now.
Yep.
The same thing happening on the credit cards. The amount of debt versus
happening
how
on
much
as well.
Yeah.
Are we looking at?
We're just beginning.
2007, 2008 all over again?
Yes, that's exactly what's going on.
Yeah, I agree with you. I believe so. I don't think 2023 is going to be a very happy year for many people. But
so So right now, as we talk marketing, then as we're talking about this, we're seeing all these variable rates, as
Yeah.
they'll call them, instead of adjustable, variable, make it feel better, are starting to climb. So people's payments are becoming larger and larger. Their debt's becoming more.
Yeah.
So now the marketing machine, John, is saying, hey, how about this personal loan to wrap all of that in there? Is that a wise thing to do? Is it not a wise thing to do? People with equity in their home because home values are as
Yeah,
high
take
as
that
they've
money,
ever been.
get that HELOC, take that money out of your home and pay off
Yeah.
your other debt.
Yeah. What? And I don't know. Maybe you're going to cover this in your live seminar, tomorrow. But are those wise things to do?
Well, certainly, if you've got bad credit or marginal credit, they're not going to give you an unsecured uh, installment loan. Now, if you get a HELOC, you're right back to it again, where you're borrowing against the equity of your house. If you lose a credit card because you can't pay it, that's one thing. But if you can't make the HELOC on top of your house payment, then they can take your house. So I think it's a matter of priorities.
Yeah.
Yeah, you're swapping debt is what you're doing, and you're doing it for the sole purpose of saving some money, because instead of paying that 29% credit card, you're going to get that loan at 8%, 9% on that HELOC. And so, you're saving that, but like John says, what you don't realize is the risk you're taking in doing that.
Yeah.
So you need to balance that. Is it right or wrong? No, it depends. It depends on your personal financial situation. And there's more to look at that than just that, because life happens kind of things,
Well, Well, the other is most people don't have the financial savvy or education to, once they do what I would call restructure, not consolidate. You're restructuring or moving around your debt, as you said.
It's something that nobody talks about. Again,
well,
you don't talk about it with your wife, your husband, your significant other.
This is a common thing with the student loans, right? So you come out of college with student loans, and they're finding out they're paying 9, 10, 11%. And y'all who have student loans right now are finding out that those interest rates are adjustable, variable, because they've gone up, and then your payments have increased for the same amount of money. But what some folks did was they said, okay, instead of that, when rates were at 2 3/4 and 3%, they locked it into a loan. Okay, now here again is the risk. You give up the opportunity to defer when you do that, but you've just reduced your payments, locked them in, and guaranteed to be done with them in a shorter period of time. Because a credit card debt, if you pay the minimum every month, it takes 30, 40 years to pay them off?
Well,
That's it. Yeah.
and people go right back to that same thing, right? Is, hey, I put all that into my home equity line of credit or my home equity loan, but because I get airline miles on Amazon, I'm running back up my credit card debt.
And that's fine if they pay it off
if they pay it off.
within a short period of time.
21 to 25 days.
I heard when I was a kid, my banker said, Kurt, he had said that you don't borrow money for any longer than what you're going to use it for. So if you're going on a vacation, it's going to take you're going on a week's vacation, you should be able to pay that back in a week.
Right.
And I've kind of always lived by that. Like, okay, how do we do this?
Yeah, you have to be careful with credit, and I think anybody and everybody who's out of college and older has probably run into some kind of issue with credit at some point in their life.
So once again, we're on the backside of this. We're here at the top of the hour. But tomorrow, John is doing a webinar absolutely free at 11 Central. Sign up at creditgenie.us. So Credit Genius / credit education. If you go out to creditgeni.us, you can email him. He'll work with you. He'll absolutely let him know you heard him.
Free
on
book,
the show.
free review.
You get a free book, free review of credit, all that good stuff.
Where can you get something for free these days?
Yeah.
Right here at 21.
Credit Karma.
That's it. Yeah, right. But yeah, John, I think what you have is timely and important for everybody because nobody's been there's been no literacy, no education on
Yeah.
this. So it's brilliant what you're doing. Yeah.
Yeah.
Well,
No,
thank
it's just you have some fans out there who appreciate what you're doing, and thank you for bringing this to my attention as well.
Well, yeah, Bill, I appreciate it, the opportunity to be able to speak, because I think, once people know the truth, it's a lot easier to live. It's a lot easier to stand tall. And that's why I say, I've got a presentation called Stand Up. And it's just a matter of taking control of your life because none of these problems go away. You got cancer or something, God forbid. And I've got a friend of mine that's got cancer right now. But if you take care of it beforehand, before it festers, it becomes a lot easier to deal with. Maybe that's a bad example, but
Thank you so much for coming on the show. We so appreciate it.
Yeah.
We'll look forward to getting you back here and maybe get into a little bit deeper on this. But take control. I love that.
thank you guys.
You got it, Providence here, 21-6 in the net. Thanks for getting caught in the net. And remember, until we meet again, be good, but more importantly, be good to one another.